Welcome to another video on my channel. Today I'm going to talk about ICT's market maker model, showing you how to spot them in the market, explaining SMT divergence, smart money reversals, as well as the fractal nature of markets. In addition, I created a short course in form of a PDF covering all the different topics I'm going to talk about in this video. So make sure to check that out in the description. You will be navigated to a page where you can type in 0 if you want to get it for free, or if you want to support me, you can type in whatever you want. Also, I would appreciate if you like and subscribe to help the algorithm show the video to more people. Now, before I deep dive into the market maker model itself, there are 3 things you need to understand before actually trading the market maker model. And this goes for every strategy. You need to know these three simple things. First, price rebalances to inefficiency. What do I mean by that? If market just broke structure, so we have this impulse to the upside and market broke an old high. The next thing we can expect is a move into an inefficiency. So let's say we have a fair value gap right here. The next thing price will do is it will rebalance to this inefficiency before continuing higher, if we were to continue the trend, of course. But 90% of the time this happens. Price returns to an inefficiency. The next thing price does is it hunts buy side or sell side liquidity. I think this is pretty self-explanatory. So price always seeks liquidity, either external liquidity or internal liquidity. A swing high, for example, would be external liquidity, and a fair value gap or an order block, whatever there is, would be considered internal liquidity because it's inside of a range. So in this case, let me just copy that. In this case, we return to the inefficiency like I explained before, and the next thing we can expect is again that price targets buy side or sell side liquidity. Third things that price does is it rebalances to equilibrium. Now, what do I mean by that? A range has a starting point, in this example a higher low, and an ending point, a higher high. And the middle of this range is called the equilibrium. This also goes for fair value gaps. A fair value gap has a start, an end, and an equilibrium. So the equilibrium is always the center of an impulse or a PD array. In this case, we can draw the Fibonacci retracement to show us the equilibrium, and price would either return to a PD array in the equilibrium of the range or even further into the OTE before continuing higher. So the market maker model starts with the original consolidation, which you can see right here. In this case, I drew a consolidation because this is a textbook setup. In 80% of the cases, it will probably not look like this. The original consolidation could be equal highs, or you could also have low resistance liquidity, something like that. Or it could also simply just be a swing high. So you have a higher high, a higher low, and then a higher high, and that's the start of your market maker buy model. For the market maker sell model, so MMSM, it would be the opposite. So this would be the market maker sell model. But in this video, I'm only going to cover the market maker buy model. So we have the original consolidation, and then we get the different stages of distribution, engineering liquidity. So then we have the different stages of distribution, which are engineering liquidity. So we have these different swing points in the market, which can later be targeted for take profit levels. And this is called the sell side of the curve, where institutions engineer the liquidity. Then we get a mitigation of the higher time frame PD array and a smart money reversal, which I'm going to go over in a minute. Then we have the accumulation and the reaccumulation, targeting the original consolidation high. This might be a bit more familiar with you because it's pretty much all over the internet. And this is called the smart money reversal, or SMR, which is essentially just a change of character flip, or a market structure shift flip, however you want to call it. And it all starts with an SMT. An SMT is when two correlated assets move out of sync. So they typically move in sync. If one creates a lower low, the other one also creates a lower low. And if we get an SMT, they move out of sync. So if, let's say, Euro USD creates a lower low and moves higher, then GBP USD creates a higher low and also moves higher. And the point where we get the lower low or the higher low, this is the SMT. And this means that manipulation has happened. The institutions are entering their positions, they are building up their positions, causing a market structure shift and a change in state of delivery. So we get a engulfing candle right here, and then an impulsive shift to the upside. And that's also what I'm looking for. I don't want to see like a small shift to the upside. I want to see a big impulsive move to the upside, leaving behind an imbalance. And that's the third part of the smart money reversal. It needs to leave some kind of inefficiency where price returns to. Again, here we are at the topic I discussed earlier in this video. This is a thing price does. It breaks structure and moves from external liquidity to internal liquidity to then again hunt buy-side liquidity. At the smart money reversal, you would also get your first entry opportunity, which is called the low risk buy. Why is it called low risk buy? Because, okay, let's say you enter a position right here with your stop loss below this low, targeting a recent high. If price goes against you and hits your stop loss, then the whole thing would be invalid and you would not trade this model. Because if the smart money reversal is the most important part of the market maker model. if this breaks structure and stops you out, you will not trade it. And the reason it is called low risk buy is because you can have a really tight stop loss. Otherwise, again, it is not valid and you should not trade it. The next important point is that models repeat themselves over and over again within each other because markets are fractal. What do I mean by that? Let's say we have an impulse to the upside on the 4-hour time frame. Yeah, it's a clean impulse to the upside breaking structure. On the 1 hour, this might look a little bit different. This might look something like this. We have a small impulse to the upside and then a small retracement. And again, a small impulse, small retracement, small impulse. And if we then drop down to another lower time frame, every of these impulses and retracements can be divided into an impulse and a retracement. And in theory, you can repeat this over and over again because every impulse, again, has its own internal structure. And understanding this, we also know that we can get infinite amounts of setups with the market maker buy model or sell model. Okay, so models repeat themselves over and over again within each other, as an impulse has its own internal structure and the internal structure again has its own internal structure. So let me just draw it out. We get an impulse to the upside with a PD array, an efficiency, fair value gap, order block, whatever. And then we get a original consolidation with the different stages of distribution towards the PD array. Here we get the smart money reversal, as we've talked about on the previous slide. And then the first stage of accumulation, sweeping this engineered liquidity. Now, what do we have again? An impulse. So at the start of this model, we get an impulse leaving behind an inefficiency. And right now we have a second impulse, which on the lower time frame can have another market maker buy model. So we could have another original consolidation followed by the different stages of distribution with a smart money reversal getting the next impulse. And this can be repeated over and over again until we break the higher time frame original consolidation high. And every small retracement towards the PD array can be what? A market maker sell model. So if you have an impulse on the higher time frame and drop down to a lower time frame, you can again look for more market maker buy models. And this is how you also trade this model. The first entry would be right here at this smart money reversal, targeting this first engineered liquidity level. the next entry would be right here at the second smart money reversal, targeting the next liquidity level, and the last entry would be at the third smart money reversal, targeting the original consolidation high. So we've talked about the basic structure of the market maker buy model, and now it's time to go over some real life chart examples and look for this model. And as you can see, I've already marked it up. We start with an original consolidation, which in this case is just a swing high. Then we get the different stages of distribution until we get the smart money reversal. We get an SMT with GBP/USD, which you can see right here. GBP/USD creates a higher low, and EUR/USD creates a lower low right here. And this is what we would consider the smart money reversal, the SMT. Yeah, we then get a displacement and a retracement into this breaker block, and then the first stage of accumulation. Now again, we have external liquidity in form of swing highs and swing lows, and we have internal liquidity in form of, for example, here we have a fair value gap which hasn't been mitigated. We have this demand zone, and we have this demand zone right here. And applying the knowledge we gained at the beginning of the video, we know that price tends to do three things. It tends to hunt buy side or sell side liquidity, it rebalances to inefficiency, and it rebalances to equilibrium. Now, it already rebalanced to equilibrium, as we can see right here. I have marked up the low and the high with the Fibonacci retracement tool, and price is already below the 50% mark. Also, we mitigated this order block or this demand zone right here, which could mean, I'm not saying that this will happen, it could mean that we will now continue the trend to the upside. Or we don't continue to the upside and retrace further into the extreme parts of the range, in case the OTE range. But I'm pretty confident that next week we will get a continuation, and you can see that we again have this impulse like we have at the beginning of this higher time frame for our market maker buy model. We get the impulse and then all the rest, and now again we have an impulse, because markets are fractal. Markets repeat themselves, and applying this knowledge can help us to find more entries, because we have this impulse, and now this could become our next original consolidation high, because this could be an original consolidation, the different stages of distribution, a smart money reversal with the following levels of accumulation. Same goes for GBP/USD. We have the smart money reversal on the higher time frame, and on the lower time frame we have external liquidity. We have this range. We also already returned to equilibrium, so we could look for a PD array where we could potentially enter. I'm looking at this demand zone right here, which could act as our next PD array with an original consolidation, the different stages of distribution with engineered liquidity, then a smart money reversal right here, and then the accumulation, sweeping the engineered liquidity. So this was it with the video. I hope you found it helpful and learned something new. If so, please like and subscribe, and if you have any questions, feel free to write a comment and I'll reply as soon as possible. Thank you for watching, and see you the week after next week, because next week I'm in Berlin, so I won't be able to post as much. So yeah, see you.